Hi, this is Sean Farmarzi with Bullock Russell Real Estate Services. I am here with Dave Marzinki with Movement Mortgage, and he is the loan officer that I always go to if I have any questions or if I have clients that are, looking for good rates and need to qualify in different ways and fashions. So, hi, Dave. How are you?
I'm good. Thanks for having me on today, Sean.
Thank you for joining us. Oh my gosh, let's talk about rates. A little crazy, right?
It's a little different animal than it was, 12 months ago.
So. Yeah, exactly. Even like 4 months ago, right?
Yeah,
a little different,
exactly.
right?
Yeah, totally.
Yeah. So I'm going to just leave it up to you. Talk about 30 years, 30 year for fixed, 20% down, those types of things. What are the rates? Tell us a little bit about, the buyer's buying power versus what it was last year. And then we'll talk about refinancing, things like that.
Sure. So right now, obviously, we've seen rates tick up quite a bit, since the beginning of the year and a lot from where their lows were last year. So typically the lowest point we were like at 2.625, 2.75 on a 30-year for most scenarios.
Yeah.
And then now we're in that range where we're at 3.375 to 3.5, depending on the scenario, especially, good credit and 20% down on a 30-year fix. So, if you take a look at it,
we're talking about, I'm sorry, conventional loan,
yes,
right?
Conventional rates.
Correct, yeah, there we go.
Fannie Mae, Freddie Mac rates.
There we go.
Yeah, so at 2.75, on an $800,000 loan, your payment was about $32.65 for principal and interest, right?
Right.
And now that same loan, the payment's going to be at $35.72.
Mm-hmm.
So you've lost about $200 there on the payment. Well, $300 on the payment there. So to keep that payment as it was before at that older interest rate, you'd have to drop the loan amount down to $725,000. So you lost about $75,000 in buying power. So
plus
the appreciation that's occurred.
So, yeah, the appreciation that happened since, right? So so absolutely.
Just from a pure borrowing standpoint, it's about $75,000 that you've lost in borrowing against on the 30-year fixed program. So.
Exactly. And this is with 20% down. But the question is, we know that the rates will keep on going up probably for the next year, at least another 2 to 3 times. Is that correct or not?
Well, what we've seen forecasted is that everybody, all the economists and the market is, kind of baking this in, is that, the Fed's going to raise the federal funds rate at least 3 times this year.
Yeah.
And so the federal funds rate is a short-term interest rate. It's what banks pay to borrow money from the Federal Reserve. So that doesn't necessarily mean that mortgage rates are going to go up substantially, or they're going to continue to rise every time the Fed raises the federal funds rate, But the thinking is that in this beginning part of the year, through the first 6 months, maybe the first 10 months of the year, that rates are going to continue to rise, and we will see an increase in the 30-year fixed rate. And then a lot of economists are predicting that towards the end of 22 and then maybe the beginning of 2023, we're going to see rates come back down. And the reason why is that they're forecasting, and you can go back and look at different points in history, like the early 80s and then also the end of the 90s, where when we had higher inflation and the Fed raised the rates to curb inflation, then a recession followed, and then interest rates came back down. So.
Yeah. Once and obviously it's going to, it won't, the prices of the homes will sort of stabilize. I'm assuming that's going to be when they decide, in order to revive it again, to curb the interest rate hikes and all that, right?
Yeah, I mean, they just mainly want to curb this inflation issue, right? And then, supply and demand hopefully even out, and then home prices will go back to the normal appreciation, the historical appreciation around 4 to 5%. But I think we're still seeing what 10% this year as far as what the forecasts are for appreciation in Orange County.
Exactly. Yeah. I don't know, 5 to 10% probably.
Nobody's got the exact number. So.
Yeah. It's never is. Okay, so tell us about, I know a lot of people have been buying, especially after COVID, there's second homes, vacation homes, second homes. And I know that there are now some increases in some fees. If it's a Fannie Mae, Freddie Mac loan that they're getting. So tell us a little bit about that.
Yeah, this is a big topic because this is impacting the market, substantially, especially in areas where people are buying the second homes, Arizona, Texas, Florida, all those things. So what we're seeing is that they just announced probably about 2 weeks ago that they're going to be instituting some increases in what they call their loan level pricing adjustments. These are just the things that Fannie Mae adjusts into the interest rate based on the risk profile of the scenario. And so if you're buying a second home right now, you can go all the way up to 90% loan to value, meaning just put 10% down. And the only adjustment is that there's a 0.25% adjustment to the cost of the rate right now if you only put 10% down on a second home. Okay. That's going to go up to 4.125%.
That's insane.
At 10% down. So the same interest rate right now on a second home is, well, right now it's about 3.5, 3.625 on a second home. That's going to go up to about 5%. Same scenario as far as the interest rate. So yeah, it's going to be a big impact. So if people are looking at buying second homes, they definitely want to do something because these rates are going to, these are for loans that are delivered to Fannie Mae after April 1st. But lenders are going to start putting this into their pricing, mid-February, beginning of February, depending on the lender, because they're going to lock those rates in and deliver those loans after April 1st. So it's going to be substantial. But there's other programs that are out there that are not Fannie and Freddie that, if you work with the right lender, they can look at those options because they have those available, and those might be less expensive than what the Fannie and Freddie rates would be at that time. So,
yeah, of course. Okay. Talk about refinancing a little bit. What are the rates for refinancing and things like that?
Yeah, so refinancing, the rates are, same type of thing. They've gone up, obviously, but there's going to be some things put in place for cash out refinances that those are going to become more expensive. And then, if you have a home equity line of credit, you might want to look at consolidating that with your first mortgage, because those are variable rates on the home equity line of credit. And so, and those are short-term rates. So when the Federal Reserve does raise the Fed funds rate, that's going to impact home equity line of credit. And so, those rates and the payments on those will go higher as the Fed raises rates.
Okay. And I think you were saying that if they do a cash out and if the loan is 80% or more, is that when the rates are higher? Is that what it is, or there was? Remember this.
Yeah, when you do a cash out refinance, you're capped at 80% of whatever the value of the home is. That's the most that you can do as far as your loan amount under Fannie and Freddie. Right now, if your loan amount is over $647,000, it's going to cost you 1 point for that interest rate because it's a cash out refinance. That's going to go up to 1.75 points.
Okay.
So there's just an increase to the cost of the rate.
And that is again, loans that are delivered by April 1st. Is that correct? Or no?
Correct. So so any loan that's delivered to Fannie Mae after April 1st, which means that it's going to be put into the pricing, probably mid-February. So.
Okay. Sounds good. Talk a little bit about 10-year ARM and 7-year ARM, because I'm assuming some buyers will need to go to those types of loans, based on, what they can pay.
We are seeing that, and our job is to present all the options and, and educate borrowers so that they can make the best decision. But an adjustable rate mortgage, especially one that's fixed for 10 years, can make a lot of sense for a lot of people, because most people don't keep their loan longer than, say, 7 to 10 years, because life changes and there's some circumstance that leads them to change things on their mortgage. But those rates right now on a 10-year ARM, you can get at 3% right now. 7-year ARM, you can get it like 2.75, 2.65. So, for this right circumstances and the right borrower, then that could make a lot of sense for them.
And what's the balloon on that?
Well, there's no balloon payment, but what happens is after it's fixed for 7 years, then it goes to an adjustable rate, and it's going to adjust once every 6 months. And there's caps that are built into that. So the first adjustment period, the rate can't increase more than 2% above the start rate. And then for the life of the loan, it can't increase more than 6% above the start rate.
I got it.
So it can never be more than 8.75 on a 7-year ARM based on today's numbers.
Yeah. Okay. Sounds good. Anything else you want to share? Buyers, I'm assuming, should be buying now. Yeah,
I mean, it makes sense that, we're going to continue to see appreciation. You're going to continue to see a rise in rates here this year. So, sitting on the fence is not going to put you in a better position right now, unless you just, you need to save, a few more dollars before you pull the trigger. But, the cost of waiting is out there. It's definitely something that you got to consider. So.
Yeah. And we're seeing, I mean, obviously the demand has been high for, past year or so, but all of a sudden we're seeing that, buyers are, I am already seeing that they are rushing to buy because of the interest rates, and they are looking at things that might be a little less expensive because, the payments will be now the same. So definitely, I say if you're a seller, obviously we know that there will be, appreciation, but don't necessarily count on, anything like it was last year. Obviously the buying power, for the buyer in Orange County, the median now for single family home is 1.2 million. And for attached home or condo, it's 665,000. If it's a 3-bedroom, normal 3-bedroom, you're looking at 800 and something thousand. So that's why, so those are some of the stats. But just share the phone number and information if you can, Dave. And that would be great.
You can reach us at 949-449-2477, or you can go to the Marzinke Lending Team .com, and that'll get you to our website, and all of our contact information is there.
Perfect. Thank you so much, Dave. Really appreciate your time.
All right. Good to see you again, Sean. Have a great day.
It was great seeing you. Take care. Bye-bye.
All right. Bye-bye.